Hello, everyone. Today is Thursday, June 26, 2025, and I'm Brian Tokuuke, Portfolio Manager here at the Rice Partnership. Here with me today is Steve Schoenfeld, Senior Strategist who works out of our California office, who will be going over a term we've been hearing a lot lately, bond vigilantes. Steve, thank you for joining us today.
Hey Brian, hi there. I hope everybody's doing well today.
All right, Steve. Well, first question to you. Who or what exactly is a bond vigilante?
Yeah, we've heard a bit more about the term bond vigilantes. It kind of came about back in the 80s when there was concern about the level of government debt going on in the United States. And it was investors, borrowers who were essentially selling bonds, driving down prices and driving yields higher, and so increasing the borrowing costs for the government.
Awesome. So, have we seen them back in action recently?
Yes, we have, and I would say it kind of started after the tariff announcements in April. We had actually seen the 10-year Treasury yield drop below 4%, but there was a bit of concern, again, focused on debt to GDP. And so we actually saw the 10-year yield spike to over 4.6%. And it was in a pretty short period of time. And so that was somewhat of a red flag. And essentially, you could say the bond vigilantes were potentially back selling bonds, driving yields higher, making their concerns known to the market.
I remember those are some really turbulent few days for the markets when the stock market was really selling off and yields were just spiking higher. Really odd times for us. So, in your expert opinion, Steve, do you think bond vigilantes are a good thing for the capital markets?
Yes, I do. I think balance is certainly a good thing to have in the markets. You don't want to have any markets too off sides where you've got more buyers versus sellers and really driving more volatility and price in one direction. So, yes, in general, I would say that they're sort of a check. The bond vigilantes are a bit of a check on the market in that we continue to focus on debt to GDP. Prior to the pandemic in the US, we were at about 100% debt to GDP. And actually, recently, the estimates for 2025 this year is that total debt in the US is around 37 trillion versus GDP, which is at around 30. So we're well over 100%. And that's where the bond vigilantes concern is coming into play.
Awesome. Well, Steve, we really appreciate your summary about bond vigilantes. Before signing off, I just wanted to mention that both Steve and I, we specialize in the municipal bond market. Steve specializes in California bonds, while I specialize in Hawaii bonds. And we just wanted to mention that if you're in the highest tax bracket, it's a really good time to get into municipal bonds because we're seeing yields north of 8% on a taxable equivalent yield basis. So if you're interested, please feel free to reach out to us and hopefully we can try to schedule a meeting with you. Steve, once again, really appreciate your time and thank you for your summary on bond vigilantes. And to everyone tuning in, thank you very much for watching.